Welcome to Iraqi Dinar News, where you receive real and authentic updates about the Iraqi dinar. If you want to stay informed with moment-by-moment developments, make sure to subscribe to the channel and like the video. Our goal is to provide balanced, fact-based analysis that helps you better understand Iraq's economy, monetary policy, and the developments that may influence the Iraqi dinar over time. Let's get started with today's important discussion. Today's topic takes us back to one of the most significant monetary decisions made by the Central Bank of Iraq over the past 2 decades. During the COVID-19 crisis, Iraq faced one of the largest economic shocks in its modern history. Global oil prices collapsed, economic activity slowed dramatically, government revenues declined sharply, and policymakers were forced to make difficult decisions to stabilize public finances. One of those decisions was the adjustment of the Iraqi dinar exchange rate. During the height of the pandemic, the Central Bank of Iraq adjusted the official exchange rate from approximately 1,182 Iraqi dinars per US dollar to around 1,450 dinars per dollar. This represented a depreciation of more than 20%. And marked the largest exchange rate adjustment since 2003. While many observers describe this move as a devaluation, it is important to understand why it happened and what it actually meant for Iraq's broader economy. At the time, Iraq depended overwhelmingly on oil exports to finance government spending. Oil revenues account for the vast majority of government income, meaning that when international oil prices decline significantly, the country's fiscal position comes under immediate pressure. During the pandemic, global demand for oil fell sharply as travel restrictions, lockdowns, and reduced industrial activity spread across the world. Iraq suddenly found itself earning far fewer dollars from oil exports while still facing enormous obligations to pay salaries, pensions, social benefits, and public services. Because government spending in Iraq is largely financed through oil revenue earned in US dollars, converting those dollars into more Iraqi dinars through an exchange rate adjustment provided additional local currency resources for the national budget. In practical terms, every dollar received from oil exports generated more dinars after the exchange rate was adjusted. This helped reduce pressure on public finances during an exceptionally difficult period. However, this policy also came with important costs. Imported goods became more expensive because more dinars were required to purchase each US dollar used for international trade. Since Iraq imports a substantial amount of food, consumer products, machinery, medicines, and industrial materials, higher import costs contributed to increased inflation and reduced purchasing power for many households. Families felt the impact through higher prices on everyday goods, creating additional economic challenges during an already stressful period. As global conditions gradually improved and oil prices recovered, Iraq's fiscal situation also strengthened. Oil production increased, international energy demand returned, and government revenues improved considerably. With stronger dollar inflows from oil exports, policymakers were able to partially reverse the earlier exchange rate adjustment by moving the official rate back to approximately 1,320 dinars per US dollar. That reversal demonstrated that the earlier exchange rate adjustment was closely tied to temporary fiscal conditions rather than a permanent restructuring of Iraq's monetary system. Nevertheless, the exchange rate did not return to its previous level of around 1,182 dinars per dollar. This distinction is important because it illustrates how policymakers balanced economic recovery with concerns about fiscal sustainability and financial stability. The news paragraph we're discussing today argues that these historical exchange rate changes were driven primarily by short-term financial pressures rather than structural banking weaknesses. In other words, according to this viewpoint, the exchange rate adjustments reflected the government's immediate need to manage reduced oil revenues instead of fundamental problems within Iraq's banking system itself. This is an important distinction because temporary fiscal measures and long-term structural reforms represent two very different policy approaches. Temporary measures are designed to help governments navigate periods of crisis, whereas structural reforms aim to improve the underlying strength and resilience of the economy over many years. One of the recurring themes in discussions about Iraq's economy is the country's heavy dependence on oil exports. For decades, crude oil has remained the primary source of foreign currency earnings and government revenue. This dependence has allowed Iraq to generate significant income during periods of high oil prices, but has also exposed the country to substantial risks whenever global energy markets weaken. Economists often describe this as a concentration risk. When a country's income depends heavily on one commodity, fluctuations in international prices can rapidly affect government budgets, employment, infrastructure investment, and economic growth. The COVID-19 crisis offered a clear example of how vulnerable such an economic structure can become during unexpected global disruptions. This brings us to another major point mentioned in today's news. The discussion references proposals associated with economic reform efforts aimed at increasing non-oil government revenues to somewhere between 45 and 50% over time. Whether those precise targets are ultimately achieved depends on many factors, including successful implementation of reforms, private sector development, tax administration improvements, investment attraction, and broader economic diversification. The broader concept behind these proposals is straightforward. A more diversified economy is generally more resilient. Instead of relying almost entirely on oil exports, Iraq would ideally develop stronger manufacturing industries, agriculture, logistics, tourism, technology, financial services, construction, and other productive sectors that generate employment and tax revenue. If successful, such diversification could reduce the government's exposure to oil price volatility. During future periods of declining energy prices, policymakers might face less pressure to implement emergency fiscal measures because multiple sectors of the economy would continue generating income. For Iraqi dinar followers, this point is especially important. Long-term currency stability is often supported by strong economic fundamentals rather than isolated monetary decisions. Stable public finances, diversified exports, sustainable government revenues, manageable inflation, efficient financial institutions, and investor confidence all contribute to a healthier monetary environment. Another interesting aspect of today's discussion concerns expectations surrounding Iraq's future exchange rate policy. The paragraph mentions that the exchange rate is not yet moving to the foreign exchange market and references forecasts suggesting values above $3 per dinar. Here it is essential to separate verified policy from speculation. At present, there has been no official implementation of an internationally traded Iraqi dinar exchange rate at the levels mentioned in speculative forecasts. Various commentators, analysts, and online communities have expressed differing opinions over the years regarding possible future exchange rate scenarios. However, such projections should not be interpreted as confirmed policy decisions. Currency values are influenced by numerous economic variables, including productivity, trade balances, foreign reserves, inflation, capital flows, monetary policy, political stability, banking sector development, and investor confidence. Significant exchange rate changes generally require comprehensive economic conditions that support long-term stability. Therefore, while discussions about possible future exchange rate developments continue to generate interest, it is important for viewers to distinguish between official announcements issued by Iraqi authorities and independent forecasts or opinions expressed by commentators. When evaluating reports related to the Iraqi dinar, one helpful question to ask is whether the information originates from an official institution such as the Central Bank of Iraq, the Iraqi government, or recognized international financial organizations. Official policy announcements carry considerably more weight than unofficial predictions, circulating through social media or online discussion forums. Looking at the short-term implications of today's discussion, the key takeaway is that Iraq's exchange rate history reflects how external economic shocks can influence domestic monetary decisions. If oil revenues remain relatively stable and government finances continue improving, policymakers may have greater flexibility to pursue broader economic reforms rather than emergency crisis measures. Continued investment in infrastructure, electricity, transportation, digital banking, and private sector development could gradually strengthen the overall economy. Improvements in customs administration, tax collection, anti-corruption measures, and financial transparency could also contribute to healthier public finances over time. From a monetary perspective, maintaining sufficient foreign currency reserves remains one of the central bank's most important responsibilities. Strong reserves help support exchange rate stability, reassure financial markets, and provide policymakers with greater flexibility during periods of global uncertainty. Inflation management also remains an important consideration. Exchange rate decisions affect import prices, household purchasing power, and business costs. Policymakers generally seek to balance fiscal needs with price stability in order to protect consumers while maintaining confidence in the national currency. In the longer term, the success of Iraq's economic transformation will likely depend less on individual exchange rate adjustments and more on sustained structural reforms. Diversifying revenue sources, expanding private investment, strengthening financial institutions, improving governance, increasing employment opportunities, and modernizing infrastructure all have the potential to contribute to stronger economic fundamentals. International investors often pay close attention to these broader indicators. Stable institutions, predictable regulations, efficient banking systems, reliable legal frameworks, and transparent economic policies can help attract foreign direct investment. Increased investment may support job creation, industrial expansion, technology transfer, and long-term economic growth. For Iraqi citizens, a stronger and more diversified economy could ultimately provide greater resilience against future global shocks. Rather than experiencing severe fiscal stress whenever oil prices decline, multiple sectors of the economy could help maintain government revenues and economic activity. For followers of the Iraqi dinar, today's discussion serves as a reminder that currency movements rarely occur in isolation. Exchange rate policy is interconnected with fiscal policy, international trade, monetary management, political stability, and overall economic performance. Understanding these relationships provides a more balanced perspective than focusing exclusively on numerical exchange rate targets. It is also worth remembering that economic reforms typically unfold over many years rather than weeks or months. Major structural changes require legislation, institutional capacity, investment, regulatory improvements, and consistent implementation across multiple government agencies. Progress is often gradual, with measurable improvements occurring over extended periods. As financial news consumers, maintaining realistic expectations is essential. Markets respond to confirmed policy actions rather than speculation alone. Responsible analysis involves evaluating verified information, understanding economic context, and recognizing both opportunities and uncertainties. The history of Iraq's COVID-era exchange rate adjustment demonstrates how extraordinary global events can force governments to make difficult monetary decisions. It also illustrates that economic recovery can create opportunities to adjust policy as conditions improve. Yet it simultaneously highlights the importance of reducing structural vulnerabilities so that future crises have a smaller impact on national finances. If Iraq succeeds in expanding non-oil revenue, strengthening domestic industries, modernizing its banking sector, and continuing broader economic reforms. Those developments could contribute positively to long-term economic stability. However, the pace and outcome of such reforms will depend on sustained implementation, political continuity, regional stability, and evolving global economic conditions. For now, viewers should continue monitoring official statements from the Central Bank of Iraq, government economic ministries, and internationally recognized financial institutions for confirmed developments regarding monetary policy, banking reforms, exchange rate management, and broader economic strategy. As always, our commitment is to provide careful analysis based on verified information while avoiding speculation that cannot be supported by official evidence. Responsible financial reporting helps viewers make better informed decisions by focusing on facts rather than rumors. Thank you very much for watching today's analysis. If you appreciate responsible, balanced, and factual coverage of Iraqi dinar developments and Iraq's economy, be sure to subscribe to the channel and turn on notifications so you never miss future updates. Remember, this content is provided for informational and educational purposes only. It should not be considered financial, investment, or trading advice, and viewers should always conduct their own research and consult qualified financial professionals before making any investment decisions.